the following strategy can help you to maximize your efforts in the least amount of time and record consistent results over the long term. So let's get started. The strategy involves trading price extensions in a three-wave pattern only using price action and the Fibonacci 161.8 level. Our aim is to trade price action that takes place primarily in the third wave of a third wave pattern. A third wave pattern is a simplified Elliott wave cycle. If you are familiar with Elliott wave theory, you probably know that trying to trade it in real time is quite difficult, especially for beginners. The major problem is that you cannot really recognize an Elliott wave until it has already passed. So I decided to focus only on the first three waves of the cycle, and let me explain how I do this. Price within all major financial markets tend to move in a fairly predictable manner. Essentially, the market is composed of impulsive price moves and corrective price moves. Elliott wave cycle is a five-wave pattern. Three of those waves, 1, 3, and 5, move in the direction of the underlying trend, while the other two waves, 2 and 4, act as counter-trend interruptions or retracements. Well, because Elliott waves are subjective, I decided to focus only on the first three waves, an impulsive wave, a corrective price move, and another impulsive move, which is the price movement we will trade. The three-wave pattern is used as a continuation trading setup that is designed to take advantage of the second impulsive move of the market. In any uptrend market, there is a pattern of higher highs and higher lows. In order for the trend to the upside to remain active, each successive impulsive swing must take out a point B in the formation. When price surpasses the price at the second swing, you can use this as a confirmation that a three-wave pattern is present. This is a chart that explains the concept of the three-wave trading pattern. In an uptrend market situation, price will make 3 points. Point A is the lowest low point, which forms a support level. Point B will be the highest point and forms a level that we consider as potential resistance. Point C will be the second low point, a support level, which must be higher than point A. The breakout of price above point B signals a continuation of the uptrend. In a downtrending market, the three-wave pattern forms when point A becomes the highest point. When price finds resistance and moves down, point B becomes the lowest low point and forms a level that we consider as potential support. And then price moves up and finds another resistance at point C. When price breaks the point B support level, it indicates that the market is most likely to continue downward. The most important variable in this strategy is the swing size, the first AB wave. Because our risk-to-reward ratio will depend on the strength of the first impulse move. A swing size that is too small can reduce profit targets to such narrow margins that it becomes difficult to execute them. If the swing size is too big, it could take weeks or even months to reach the target price. The trading strategy requires the following steps: defining a minimum swing size, meaning the first wave of the three-wave pattern, applying the Fibonacci tool with a small twist to find the 1.618 ratio, and taking a trade at the 50% fib level. Now stay with me for the next part because it's important. In order to find the 1.618 ratio, you could use fib extensions, but I like to do it in another way. The correct way to apply a fib retracement is from a swing low to a swing high in an uptrend, meaning from point A to point B, and from the swing high to the swing low in a downtrend. To find the 161.18 ratio, I add the fib retracement from point B to point A, so the other way around I know it might seem weird or incorrect, but this is how I like to find the 16:18 ratio. Here are the main conditions in order to find the best signals. First, we have a trend line breakout. A trend line acts as a support for the price when applied to consecutive higher lows in an uptrend and as a resistance when applied to consecutive lower highs in a downtrend. Once a rising trend line is broken, that trend line becomes a resistance for price. Similarly, once a falling trend line is broken, that trend line becomes a support for the price. Basically, the first wave, the AB wave, must be the wave that breaks the trend line, like in this example. If this sounds complicated, don't worry because we'll have plenty of examples later. Second condition, point C must be higher than point A for an up move and lower than point A for a down move. When AB wave ends, it will lead to a price move lower in BC wave that will retrace a portion of the wave 1 move. However, the second move must not fall below the start of wave 1. This is an extremely important rule. The second wave must retrace to the 38.2 fib level at most if it retraces to the 23.6 fib level. I personally ignore the setup, so the buy or sell zone depending on the setup is the area between the 38.2 and the 50% fib level. Third condition, if price fails to retrace to the 50% fib level, ignore the setup. In some cases, the trend line will be broken, but the price action won't make a decent retracement. Sometimes it will retrace to the 61.8 level and then resume its move. For this setup, we want price to retrace to the 50% level. If it doesn't, we find other opportunities. So trendline breakout, find the AB wave, apply fib retracement from point B to point A and try to take a trade around the 50% fib level. Targeting the 1.6118 ratio. It easy and most important, price action based. Here we have the setup on the pound dollar on the 4-hour time frame. We have a clear trend line breakout. Point A is the lowest point in the chart, starting the AB wave. Also, the AB wave breaks the trend line. Point B indicates a possible bullish trend, a possible because we don't know yet, the price may reverse in the opposite direction. So we apply the fib retracement. Remember the other way around, from point B to point A, point C indicates the pullback, in this case to the 38.2 level, which is a valid condition. If price stalls and rejects the level, you could switch to a lower time frame to time your entry. My preference is to enter the trade around the 50% fib level with a stop loss below the 23.6 level and targeting the 1.618 ratio. If price starts moving upwards, then the breakout of price at point B would add fuel to our position. Most traders would enter right here at the breakout of point B. But we had a smarter entry. At the moment of the breakout, we would be already in profit. When price breaks point B, you could move your stop to break even. I personally do it every time. Sometimes the price retraces to the entry point, leaving us with a break-even trade, and sometimes goes right to our target. In this example, the price continued its upward direction and reached 1.6118 ratio. Here we have the euro dollar on the daily time frame. We have the trendline breakout. Point A is the highest point in the chart starting the AB wave. And this is the wave that breaks the trend line. Point B indicates a possible bearish trend. Then we applied a fib retracement from point B to point A, price retraced to the 38.2 fib level, forming a pin bar, a reversal pattern. We entered the trade at the 50% fib level with a stop loss above the 23.6 level and targeting the 1.618 ratio. After the breakout of price at point B, price came back to retest a level, which then became a strong resistance area. When price breaks point B, we moved our stop to break even and the price continued this downward direction and reached the 1.618 ratio. And look how powerful that level was. As price reached that level, it immediately bounced back another long position, this time a continuation trade. Here's the trendline breakout with the AB wave as the first impulsive move, price retraced more than 50%. Remember, almost reaching the 38.2 level, we enter at the 50% level with a stop loss below this area and targeting the 1.618 ratio. Observe once again that after price broke the point B, that level became a support area. Price retested the level. New traders entered the market and took the price to our final target at the 1.6118 ratio. The risk to reward ratio is maybe the most important metric in this trading strategy. By entering at the 50% fib level and targeting the 1.6118 level, you get at least 3 to 1 risk-reward ratio at minimum. In most cases, over 4 to 1 risk-to-reward ratio. Remember the rules we've discussed before. If price retraces all the way to the 23.6 level, ignore the setup, and if price doesn't reach the 50% level again, look elsewhere. We need those conditions for the highest probability setups. In this example, price retraced and even closed above the 38.2 level, which invalidated the setup. And the price did retrace, most likely because of the initial trendline breakout, another important condition. And even if the price managed to close below the point B, it failed to reach our final target. You could try to trade this scenario and squeeze some points, maybe to the 100% level. The best part of this strategy is that you only have to spend 30 to 60 minutes each day, which makes it perfect if you have a busy program and don't have time to trade. Make sure you analyze the daily, the 4-hour, and the hourly time frames and avoid narrow range markets with too much or not enough volatility and other bad conditions. And yes, you could also use this strategy for day trading on lower time frames. If you learned something new and found value, leave us a like to show support and don't forget to subscribe and hit the bell icon to get notified every time we release new videos. That's it, traders. I will see you in my next video.